I'm Randy Efron from Skylattice Property Capital, and this episode is part 2 of 3 about CMBS loans for commercial, multifamily, and hospitality real estate. In my prior episode, we defined what CMBS loans are, discussed some of their advantages and disadvantages, and went over the primary loan sizing stipulations that lenders use to determine their loan proceeds. In this episode, I'm going to talk about the interest rates for CMBS loans and also discuss some more structural elements. Let's get started. The interest rates for CMBS loans are priced as a spread over the swap rate. For a 10-year loan, the spread would be over the 10-year swaps. While floating rate CMBS loans do exist, most loans contain interest rates that remain fixed for the entire duration of the loan term. Loans can be interest-only, amortized, or be a hybrid of both, such as a 10-year loan with a 2-year interest-only period followed by 8 years of principal and interest payments. For a 10-year loan, amortization periods are usually 30 years, except for hotels and single-tenant net lease properties. Hotels usually have 25-year amortization schedules, and single-tenant net lease properties have amortization schedules that correlate to the remaining lease terms of their tenants. While there are certain standards that CMBS lenders must follow in order for their loans to be securitized, the lender does have a lot of flexibility in the way that the loan is structured. Some of the structural elements of CMBS loans are as follows. Structural element number 1, rollover reserves. Rollover reserves are used to make sure that enough cash is reserved to fund tenant improvements and leasing commissions for spaces that are occupied by tenants whose leases expire during the loan term. Since the borrower depends upon a property's cash flow to pay its debt service, lenders want to make sure that vacancies at the property are quickly eliminated. Tenant improvements and leasing commissions help the borrower sign new leases. Typically, before the loan is closed, the CMBS underwriter will create a rollover schedule that projects how much tenant improvements and leasing commissions will be needed based upon the existing tenant's rollover dates. Oftentimes, an upfront deposit into the reserve will be required at closing, and then ongoing monthly deposits will be required thereafter. Structural element number 2, free rent reserve. Similar to tenant improvements and leasing commissions, oftentimes free rent or rent concessions are given to prospective tenants to induce them to sign leases. The CMBS underwriter will look at existing leases and determine whether any of the existing tenants at the property have rent concessions that will burn off. If they do, the difference between their normal rent and their reduced rent may be reserved for at closing. Additionally, free rent for future tenants will also be estimated as part of the rollover reserve analysis. Structural element number 3, deferred maintenance reserves. This reserve is typically established and funded at the time of loan closing. As its name implies, it is used to reserve money for deferred maintenance that needs to be completed at the property. Structural element number 4, replacement reserves. This reserve is used to fund ongoing maintenance at the property. Reserve deposits are typically made monthly and are calculated as a dollar amount per square foot for commercial properties, per unit for multifamily properties, and as a percentage of gross revenue for hospitality properties. Structural element number 5, cash sweeps. Cash sweeps fall under the cash management provisions of loan agreements. Cash management deserves an episode of its own, so for the time being, just know that with respect to cash sweeps, if certain things happen during a borrower's loan term, such as a major tenant leaving, the CMBS lender can activate a cash sweep whereby the lender traps all cash flow from the property in a lender-controlled bank account. The lender then prohibits distributions to the borrower until certain things occur, such as filling the vacant space with a new tenant. Structural element number 6, assumability. CMBS loans are usually assumable for a fee, provided the master servicer approves the new guarantor. Now, since I don't want these episodes to get too long, I'm going to pause here and continue talking about CMBS loans in my next episode. In the interim, if you would like to stay informed about new episodes, please click like, subscribe, or follow. Alternatively, if you want to improve your capital raising process, reduce your cost of debt or equity, or add a real estate finance-oriented CFO to your team without incurring any overhead to do so, please send me an email at randy.efron@skylattice.com. Thanks, and I'll see you next time.